Hello and welcome to our final edition of 2021 of the Markets in 3 Charts. So to round out the year, and what a year it's been, we've decided to temporarily shelve our social, economic and share price chart format and instead present 3 macro charts that are worth discussing given current markets. As always, please note, we're presenting general insights into our decision making and not investment advice. So the first chart I want to discuss today is the US public debt and stock market value as a percentage of GDP. So with the recent bout of volatility and the S&P 500 notching new all-time highs, there are concerns about whether the staggering post-COVID market run is really sustainable. But markets have been exhibiting fragility for some time. We know of the rampant crypto speculation, Volmageddon events, substantial blow-ups and defaults during some of the most buoyant of markets, and ETF and passive holders running for the narrow exits as soon as the music stops. These have just been some of the regular features over the last few years. So in this context, the question is, how can we evaluate where the markets currently sit in terms of valuation metrics? And this is where we get to chart 1. So we think it's a pretty good place to start. And the orange line here compares the value of US equities to GDP. And in 2001, Warren Buffett remarked that this metric is probably the best single measure of where valuations stand at any given moment. The red line, which shows total public debt as a percentage of GDP, provides some insight into the way that since the dot-com crash, public debt has been used as counter-cyclical financial stimulus through periods of turmoil. And as you can see, both of these measures now substantially exceed 100% of GDP, having increased substantially during the pandemic. The sustainability and affordability of public debt is really a subject for another note, but the role of the Fed in underpinning the value of the equities markets through low rates and quantitative easing in perpetuity is surely too good to be true. The Fed has already signaled that rates are going to rise to tackle inflation and provide monetary headroom for the next crisis. And with private debt levels also at all-time highs, surely this flows through to the business cycle. Crucially for investors, in an environment of too much money chasing too few basis points, just how overvalued are markets if rates are to rise? So we've used Professor Damodaran's intrinsic value calculator for the S&P 500, and assuming a rise in long-term US government bond rates of just 1% over the next 5 years, and a reversion to the long-term S&P 500 annual return of 10.5%, the S&P 500, the blue chip US index, is almost 50% overvalued. Now we get to our second chart, and that is some Robert Shiller's valuation metrics. And I'll start off with the CAPE, or it's the abbreviation for cyclically adjusted price to earnings ratio. And that's commonly known as a Shiller PE or PE10 ratio. And it's a valuation measure usually applied to the S&P 500 equity market. And it's defined as the price of the market divided by the average of the previous 10 years of earnings, adjusted for inflation. As such, it is principally used to assess likely future returns from equities over timescales of 10 to 20 years, with higher than average CAPE values implying lower than average long-term average annual returns. The current CAPE, as you can see in the orange line here, is 38 compared to an all-time high of 43.5 just before the dot-com crash in 2000. Now, in terms of the other crucial line here, which is the purple one or the pink one, is the ECY, and that's Shiller's alternative metric, which is the excessive CAPE yield, and that's how you get the abbreviation ECY. And the ECY is calculated by taking the regular CAPE earnings yield that we just talked about and subtracting the real or inflation adjusted rate on the 10-year treasury bond. So what the excess CAPE or the ECY really shows is how much the future returns on equities should exceed what you get from simply buying treasury bonds. And this is currently 3.3% compared to an all-time low of negative 1.5% in the year 2000. So what does chart 2 really tell us? Well, while the CAPE is at levels unseen since 2000, the ECY seems to suggest that equities in the context of long-term bond rates are actually at historically cheap levels. So in short, markets are simultaneously very expensive and also fairly cheap. And while this does not strike us as particularly healthy, the key insight from these two metrics is how much valuations are underpinned by low rates and the extreme reach for yield in equity markets, as investors are forced out of low risk, low yield asset classes such as bonds. And while we don't believe interest rates are returning to their historic levels anytime soon, the recent flattening of the US yield curve is a bearish sign, as it implies speculation that the Fed will increase rates in the short term. And fresh investors, unused to the look of a true bear market, and especially those who started investing before the dawn of quantitative easing, may well respond with panic. And it's not just Shiller's measures that seem to suggest that equity markets are on a serious sugar rush. Median price to sales ratios peaked at a 20-year high in November 2021. Price to book ratios are well above their 20-year average, and the weight of the top 10 stocks in the S&P 500 as a percentage of total market capitalization has also increased to record-breaking levels. And so the concentration of markets and risk is at unprecedented altitudes. Now, while of course we can't say what the future holds, we can say that at these levels, simple index investing seems perilous to us. But the question is, can't investors just hold through the storm of a market correction and simply wait it out? And this is where we get to our third chart. And that is the number of years it takes to get back to earning 6% in real terms over a selected period from beginning of a crash to until you get back to that 6% return. So you can see in the case of the dot-com crash from 2000, we're still not even there yet, 21 years later, that you still wouldn't have got 6% per annum return if you invested all your money just before the dot-com crash. So, this is really trying to answer the question, why should we care if markets are overvalued? So in this chart, each line measures the initial damage done when a financial bubble bursts, and then tracks, as I said, how long it subsequently takes an investor to climb back to that expected 6% real return, and that accounts for inflation. So if annualized returns are the measure, then time is the medium through which investors must navigate. And decades of depressed returns can be catastrophic to long-term wealth available in a person's lifetime, and it's therefore prudent to avoid any huge drawdowns. So what does Hancock & Gore Investment Management do that sets it apart? So while we remain largely timing agnostic, periodically throughout our 14-year history and previously as supervised investments, when broader market returns are so excellent that they really defy belief, the firm has taken hedging positions, it's trimmed risk and increased allocations to cash and gold, alongside the fundamental process of selecting largely uncorrelated equities as businesses to really hold for the long term. And in September of this year, the H&G High Conviction Fund started allocating a modest budget towards cost-effective risk mitigation in the form of out-of-the-money S&P 500 put options. We've also built up a healthy cash holding. As stewards of capital, it's our jobs to be the experts on risk-taking, and the directors of the firm have spent years collectively taking risk without exposing themselves to the chance of ruin. They've also done this while maintaining the benchmark outperformance necessary over the long term. And the fund's inception in November 2007 actually coincided with the beginning of the GFC. Over the next 15 months, from peak to trough, the ASX Small Ordinaries Accumulation Index returned, should I say, negative 59% compared to the fund's negative 10% net of all fees. And in the 14 years since inception, the fund has returned 8.5% per annum net of fees, compared to the small ordinaries 2.5% per annum. So I hope you enjoyed that, and I hope you have a very happy holiday, and I will see you again in 2022.